So the big question is this: how do investors like us who trade options and manage our own money generate income regardless of where the stock market goes, and do it all in a way that lets us make time for the people and things we love, and yet still build wealth and remain profitable? That's the question, and this podcast will give you the answer. I'm your host, Kirk Duplessis, and you're listening to the Daily Call from Option Alpha. Hey everyone, this is Kirk here again from Option Alpha, and welcome back to the Daily Call. Today we're going to be talking about how to calculate options profit and loss as a percentage. And the reason I want to talk about this is because I'm seeing a lot of people who are confused on how to calculate the amount of money that they're making on a trade as a percentage of the trade itself. Now, I'm not talking about calculating this as a percentage of the overall account. That should be actually pretty intuitive and pretty easy to calculate. Just figure out how much you make and divide that by the account balance that you have, and you figure out how much you're gaining on the whole account. But the end result here is that I do see a lot of people and also companies misrepresent what they're making because they're calculating everything based off of the option profit for the individual strategy or contracts that they're trading, not necessarily the whole account. So there's only two ways that you can calculate, two basic, broad ways that you can calculate the profit or loss of a position as a percentage of the trade itself. The first is based on max risk, and the second is based on margin that's required to hold the position. So the first way is pretty easy because all you have to do is figure out what the maximum risk is for any particular trade that you get into. Now, this is going to be a little bit different depending on what strategy you choose. If you choose an option buying strategy versus a spread versus a multi-leg spread, the max risk is going to be a little bit different to calculate. But in any case, you should be able to figure out for any spread trading that you're doing where you have defined risk, the maximum amount of risk that's in that position or how much you could lose if the position goes sideways. So that's going to be the basic number that we're going to use as our kind of core position size or how much we're allocating towards that position because we could potentially lose it. So that's money at risk. And so on top of that, what you would figure out is how much you made on the option strategy. If you were long options, how much you gained in option premium. If you're short options, how much you collected in option premium back at the end of the day, and figure out how much you made on that contract and divide that number by the amount of max risk that you had in the position. So to use a very simple analogy or a very simple example here, let's say that we did a $1 wide spread and we sold, let's say, a 101 call, we bought a 102 call, and we collected 30 cents of premium. And as an option seller, we have 70 cents of potential risk in this trade. So if the trade goes sideways and becomes a full loser, we lose 70 cents. If we have the trade become a full winner, we win 30 cents in our premium that we collected. And so what we would do is simply take 30 divided by 70, and that gives us a 42% return on our money if the position wins. Now, again, that's a really high return. That's the whole point of trading options, is that we're going to use a highly leveraged product like options and use it on a smaller portion of our account, keeping a lot of our account still in cash as a reserve and kind of rainy day fund. So in this case, we could generate a 42% return on this position if it went all the way to expiration. Now, the other way to calculate a profit and loss as a percentage is to use it based off of margin that's required. Now, this is only for positions that are naked or undefined risk. So these would be straddles, strangles, short calls, and short puts. Now, in this case, because when you're selling options, you don't have any way to define the maximum risk since the position can fluctuate. So what we would basically do is try to figure out some sort of initial margin or margin that's required on the position and base our percentage win or loss off of that initial margin. Now, again, this is going to fluctuate because the second you get into the position, the margin could change, it could expand, it could contract. So there's no perfect way to do this, but again, we're just using kind of this as a guideline, as a guidepost. But let's say that we were to sell a strangle around the market at some ticker symbol, and we were to potentially enter the position for $100 in credit. Well, if the strategy requires a $2,500 margin required for that position, we're looking at basically just a 4% return on our money for that trade. Now, not as great clearly as the spread trade, but the idea is that there is a trade-off here that generally undefined risk positions like straddles and strangles, short calls, short puts, make money faster. You're holding them for shorter periods of time. You can end up rolling them and adjusting them. They're more flexible. So don't look at it as a one-to-one. You also have to consider and weigh the options of, the profile of the strategy in doing a risk-defined versus an undefined risk trade. Now, I'm using a really extreme example. It's not always that extreme that selling strangles and selling straddles is a 4% return. But again, I'm just using that as an example to help you guys get a basis for how you can calculate these. So as always, if you guys have any questions, let us know, but hopefully this helps out. And until next time, happy trading. Thanks for joining us on the Daily Call. Be sure to subscribe right now for more daily options trading ideas, strategies, and tactics to help you learn how to place smarter, more profitable trades. And if you like what we're doing, don't forget to give us a rating and a review so we can continue to bring you the best daily content possible. We'll see you again tomorrow, right here on the Daily Call from OptionAlpha.com.